Good morning, ma'am. The assigned topic to me is about elements of return on equity. A similar approach can be taken with the basic formula for return on owner's equity, or ROE, which relates profit and the amounts of recorded equity. Return on equity equals net profit divided by equity. If you use sum of the basic profit and turnover relationship to expand the expression, the following formula emerges. Return on equity equals net profit divided by asset times asset divided by equity. Note that in effect, the formula states the return on equity, or ROE, consists of two elements. The first one, the net profit achieved on the asset base. The second one, the degree of leverage or debt capital used in the business. Assets to equity is a way of describing the leverage proportion. We can expand the formula even more to include key components of return on assets. ROE equals net profit divided by sales times sales divided by assets times assets divided by assets minus liabilities. Once again, we can look for the key drivers management should use to raise the return on owner's equity. It's not a surprise that improving profitability of sales or operations come first, combined with effective use of the assets that generate sales. An added factor is the boosting effect from successful use of debt in the capital structure. The greater the liabilities, the greater the improvement in return on equity, assuming, of course, the businesses of the profitability to begin with and at a minimum continues to earn more on its investment than the cost of debt. As we know, of course, value creation depends on overall returns above the cost of capital, which is not expressed in this particular formula. Using other people's money can be quite helpful until the risk of default on debt service in a down cycle becomes significant. The analyst can use this simple framework to test the impact on the return on equity from one or more change conditions, and to test how sensitive the result is to the magnitude of any change introduced. A more exclusive format of the relationship of key ratios to each other and to the three major decisions are in display in figure 4-4. We've added the major drives behind the ratio on the left as an indication of the levers management can use in managing the company. Note that in this diagram, we've included the cost of interest on debt as part of the net contribution from leverage in the financing area, while properly defining operating earnings as excluding the cost of interest. This is the format of key ratio and their elements: operating ratios, investment ratios, and financing ratios. This representation can be viewed as a simple model of a business. In accounting ratio format, it can be useful in tracing through the ultimate effects from changes in any of these basic drivers that are brought about by management decisions. For example, note that the increased level of inventories will reduce working capital turnover, which lowers the return on investment and in the end, the return on equity. Or take an increase in debt or leverage where the funds obtained are successfully invested with a rate of return higher than the interest cost. This will make a positive contribution to the return on equity. The later example also illustrates the different degrees of leverage employed by companies being compared can affect the comparability of the return on equity measures. A word of caution in this order, however, the net precision implied in this arrangement must not blind us the fact that while accounting ratios are commonly used in indicators, the ultimate driver of TSR and shareholder value is the pattern of cash flows achieved and, more importantly, expected by the stock market. This represents an economic viewpoint which transcends the shortcomings of accounting statement and relationship in increasing market valuation as a cash flow mechanism, a concept which has been confirmed by many empirical studies. The truth of the system, the left of the diagram, are the basic conditions which drive success or failure as expressed in these accounting ratios. These drivers are common to accounting and cash flow reasoning. The difference is in the way the results are expressed, as well discussed in Chapter 12. Value creation depends on effective management of all basic drivers, but the ultimate result must be viewed in cash flow terms. Does this mean that we cannot really use the various tools and relationships we've discussed in this chapter? Not at all. The challenge to analysts and managers is to constantly be aware of the cash flow implication of their decisions in addition to any accounting-based analysis. Accounting ratios and data at times will conflict in economic choices, especially in the near term, and some of them will not be useful for a particular decision. Over the long run, measures such as return on equity and return on net assets will tend to converge with cash flow results. The rule of observe at all times is that true economic trade-offs must be based on cash flows, and if decisions are constantly analyzed and executed in this manner, positive accounting results will follow in due course. We'll return to the subject of business modeling again in Chapter 5 and 6 and highlight economic cash flow trade-offs in Chapter 7 through 8. That's all. Thank you.